Good morning, it's Jeffrey Cohen. It's Thursday, June 23rd. First off, welcome to our show and welcome to the markets. So we're going to talk about recession fears. We're going to talk about what that means. And, from game theory to looking at the stocks, looking at fixed income, we saw a lot of messages yesterday that initially confused us, and then we realized there's concerns over a recession out there. And whether or not you believe that there's a recession now, the fact is people are scared of a recession. And so that's going to change certain trading behaviors. So let's start and focus on recession. Also, let's focus on the new lows versus the new highs. Let's focus on how downtrodden stocks keep going lower. And let's talk about the listlessness of the markets and how most of the action's been happening in the morning before the market even opens. So let's start. There was a Yahoo Finance headline. Stocks go nowhere. Powell calls recession a possibility. Senior markets editor. And they talk about different stocks, in different exchanges that fell. I just find it so interesting, right? After writing about markets going up, there's conversation about markets going down. So you got this whole recession discussion. So we went, and this is a picture, I just didn't want the lag. This is Fred's. This is St. Louis Fed, produces a lot of good information about the economy, about money, about all kinds of stuff. Auto sales, right? And this is real GDP growth. A recession is, I'm going to explain it first. A recession isn't some scary boogeyman. It's when the economy drops, refuses to grow for 6 months, for 2 quarters in a row. Because we measure quarterly. So 2 quarters sounds like a recession. And you'll notice here, there's a recession, and it looks like it's 3 quarters. Here there's a recession. It looks like it's maybe 5 or 6 quarters in 2008. So you got the 2001 recession. You got the 2008 recession. In 2020, as COVID hit, it looks like it was just 2 quarters. And what's interesting is you've had a couple of times when the growth has been negative a little bit. 2001, just before the recession. 2011, 2012, 2014. So dipping below doesn't necessarily mean that it's always going to go into a recession. So if you look, the last data point in 2022 is negative. It's negative 1.5%. So our real gross domestic product, which is the growth in U.S. activity, and it includes things like building inventory and its exports and its production and its consumption and its investment and it's all the good things that we do in our economy. So it fell last quarter, 1.5%. Now that's not a major crash. Like this is a 30% crash. This is almost a 10% crash. But it's still something, right? After you've been growing for a while, it hurts to fall. And I think once that recession word hits, I think you're going to see the stock market not do so well. So, question we have is, we put together a game theory matrix, and the question is, if you believe that there's a recession, or you believe that it's highly likely that there's a recession right now, that we're in it, should you sell stocks today? Forget it, sell everything. Or should you wait? And the game theory suggested that all actors should try to sell before everybody else. And the reason is that once everybody sells, all the prices are lower. If nobody sells, prices stay where they are. There's no payoff, but at least there's no loss. But if one person or one company hits the exits ahead of everybody else, they get higher prices. And so I believe that game theory, I'm not the only person in the world to do game theory analysis. There are hedge funds and money managers and large investment houses that have been selling in order to take advantage of just that very small game theory edge. I think I posted a picture of that on Twitter. I'm pretty sure we won't find it easily, but maybe we will. Let's see. Maybe we will. I just want to show it to you. It's pretty cool. I study game theory in my PhD program. By the way, that's a lox, bagel and lox. That's how I felt yesterday. Here it is. It's a stock game on recession fears. Let's move it over here. So if both parties sell, both parties lose 10. If both parties hold, buy or hold, both parties don't gain or lose anything. If one party buys and holds and the other one sells, the buy and hold loses 10, the seller gains 10. If somebody sells while the other buys and holds, they gain 10 and the other one loses 10. So the solution on this one is that they're effectively, everybody wants to sell while the other one's holding. The best outcome is everyone hangs on. But in fact, what's going to happen is everyone is going to move to the best solution, which is to buy and hold while the other one doesn't. And then ultimately, everyone's going to sell. And so the solution is a tough solution. It says people are going to sell. Even though the best outcome, if everyone was communicating in the market, is to buy and hold and to ride through any kind of recession fears. So that's the game. It's there. It's important. I just want you to know. This is one of the things we do from our education. It's kind of nice. By the way, if you'd like to leave a comment, I like that, actually. Drop a comment. Hit the subscribe button. All that stuff helps me. So let's take a look at some of the different... I really wanted to look at the action yesterday. Let's see if I can find it. Right here. Here's simple. We'll look at the Nasdaq. We'll look at the S&P. We could look at better charts, like more complicated charts, but let's just keep it simple for now. So, stocks went up. In the first hour and a half, they went up like 7 candles in a row, right? And then they dropped back to where it opened. They rose, they fell, and they closed just below the open. On the S&P 500, 7 candles up. Then it came back to the opening. It rose, and it came back to the opening and actually ended a little bit or closed a little bit lower. Kind of normal in the summer. Not a lot of people trading. There's high school and college kids trading, but there's not a lot of like big money makers trading because they're on vacation. Even I'm taking my daughter to summer camp. I'm sitting at a Starbucks, right? So it's a good question. Market's flat, right? If you stayed home, you were fine. I guess if you bought right at the open, you could have ridden it up a little, but I don't know. I'm not that clever, right? And so I saw people talk about what's sold off, and what sold off was energy. Look at how red the energy is. Jeff, you're talking about negative energy here. Well, no, I'm not. I'm talking about energy stocks. And energy stocks are down. And maybe we could take a look at it in the bubble chart. Then all of a sudden you see another view. You see Freeport-McMoRan, which is a copper manufacturer. They actually produce copper out of the ground. Down 8% yesterday. People talk about Cleveland Cliffs, right? Big, wah, Cleveland Cliffs. But Freeport-McMoRan, I'd like to see some crying on that one because I think that's a great company, great stock, and I just don't know what the right price should be. So let's see. Anything else? Nucor, right? Steel company. Where's Cleveland Cliffs? Didn't fall that much. Kind of big whiners, right? There's Newmont. A good gold manufacturer. So where's my energy? It's funny, they don't even show up on there they are. They're in green. Energy's green, light green. So Yeah, they fell. But then look at that. Cigarettes, same group. Marathon's down. Apache's down. God, I love Apache and Marathon were some of the first two stocks the model recommended November of last year, and we started running it in production. So it liked oil and gas, but now look at that. It's dropping like a rock. Chevron, Exxon down to over 4% each. Devon Energy. The Williams Company, right? They do pipelines. They're even down 1%. How could pipelines be down? Kinder Morgan is down almost 2%. How could pipelines be down? Of course you're going to fill the pipeline. So energy's down, right? And so the question is, why is energy down, right? Why are the producers and the transporters and most likely the refiners of energy down? Well, let's see if we can figure this out. I'm pretty smart. Let's see if this makes sense to me. So energy's down. That's like the big story, right? And Freeport-McMoRan. So if we look at the crypto and the miners, right? And let's take a look at it in terms of just how it did. So crypto way down. But look at that. MT is ArcelorMittal. They sold off their U.S. operations, but they're a steel company, integrated steel. $24 a share, down 8.5%, 52-week lows. Freeport-McMoRan, close to the 52-week low. God, I love that company too. There's so many stocks to buy. I just don't know what the price is when you're supposed to buy them. Because in a recession, everything goes down. The baby goes out with the bathwater. In a recession, sell. If we all hold, we don't lose. If we sell first, we get an advantage. But the equilibrium solution is a terrible one. It's you sell if you think there's a recession. You can't see that. You sell if you think there's a recession right there. So what else we got? We got a lot of chit chat on Twitter about Cleveland Cliffs. Cleveland Cliffs is down towards a 52-week low. Nucor's holding its own. It is. It's not a great performer right now, but it's holding its own. Rio Tinto, Vale, or if you pronounce it Vale, out of Brazil, holding its own. Steel Dynamics holding its own. It's got like a little niche out there, but in general, not good, right? So let's take a look at what else does badly in a recession. Specialty furniture. Kohl's is looking at selling itself, and that's down. Look at that. Hey, normally a company, when they put themselves up for sale, does well. It's getting close to that 52-week low. For all you say about retail, most of them are hitting closer to the 52-week lows than they are 52-week highs. Right along here. I'm not even looking at the names. I don't care. Target, Ross Stores, Nike. Nike is almost at a 52-week low. Burlington Stores, Burlington Coat Factory, Hydrofarm Holdings, DXL. So big and small, we've got it all. Dillard's is holding its own. It's got very few equity holders. And so there's like a dad, I think, and two brothers, and some guy named Bob, and they hold all the shares. And so Dillard isn't going to fall. But look at that. Dillard's fell 6.3% yesterday. Even family lives by game theory. I'm sorry, it's true. Now, some went up, but even the ones that went up a little, they're still very close to their 52-week lows. I want you to see that. It's the third column from the right. It's super important. So the 52-week low for Etsy is 67. It's at 74. Con Stores, the 52-week low is about $8. It's $8.60. Flex Steel, which we love, great furniture. 1752 is a new 52-week low. There's a 52-week low. It's at 1950, so it's up $2. These are very close to 52 weeks lows. Party City hit $1.09. It's $1.45. Woo, party time. But it's not party time. The whole company's worth $163 million because they're afraid it's going to go bankrupt. All right, what else we got? Jeffrey, you're bringing me down here. Okay, regional banks. How the banks doing? A lot of banks went down, but some went up. Actually, a fair bit went up. Not so much the names we care about either. I mean, FFIN, that's always an interesting one to follow. If you haven't followed FFIN, you should take a look. First Financial Bank shares. But yeah, up and down. I mean, I can go on money managers, right? The big guys out there. The Morgan Stanleys, right? Goldman Sachs. Actually, not big. Goldman Sachs isn't the big guy anymore. Blackstone, Charles Schwab, they're the big guys. Goldman Sachs is tiny. It's under 100 billion. But I just want you to look for a minute. This is 52-week range. This is 52. I just don't. Do you understand what I'm saying? This is 52-week range. And most of the money managers are trading, are getting close to the 52-week lows. Now, Raymond James holding its own. Alliance Bernstein holding its own. Main Street Capital holding its own. Gamco Investors holding its own. But in general, everything is very close to the 52-week lows. Do you know our model was picking the money managers because they went down, they basically went down and then flattened. And when you flatten, your slope is zero. Slope is zero means less risk. It's interesting. Chips and semiconductors. The entire sector was red. Now, chips and semiconductors were the high flyers when the market was going up. And now we look, you got 4 or 5 holding their own. The rest are kind of hugging that 52-week low number. So when I talk about new highs and new lows, this is what I mean. If you really dig in a little, let's take a look. So there's a favorite place I like to look for new highs and new lows. So I don't know that this is even helpful to you guys. I'm just telling you how I feel about the market, what I'm thinking, what I'm seeing, right? So it was interesting yesterday. Even though the market was flat, 3,700 advancers, 43% advanced, 52% decline. The rest didn't move. So 4,400 decliners, of which 600 hit a new low. That's 1 out of 8. New low. Lower low, right? 11 will hit a new high. Oh, yay, new high, 11 out of 600. That's like 500, that's like 55 to 1 or 56 to 1. That's crazy, guys. It's crazy. And if you're holding stocks like we are, you are bag holding. 16% of the stocks that you have are below the 50-day simple moving average. I'm sorry. 84% of the stocks that you might hold are below their 50-day simple moving average. Just take the price every day, average it. Are you above or below? Because you don't know when you bought it. 7,500 or 87% are below the 200-day simple moving average. That's 10 months. So if you bought a stock in the last 10 months, there's an 87% chance that that stock is underwater and you're holding a loss. And this guy, this jerk, says, game theory says everyone's going to sell. There's no honor among thieves. Why would you and I both hold if one of us thought we could sell for a slightly higher price? You're not. Okay, what else? What else? I'm getting a little bit morose here. Let's keep it positive. Keep it positive. Let's look at fixed income. Fixed income normally is pretty good to look at. How scary could fixed income be? It's bonds. Your mom and dad had bonds. I don't care if you're 80 years old. Your 80-year-old mom and dad, probably their grandparents had bonds. Everyone loved bonds, right, back in the day. So today I love bonds. Let's talk about it. Bonds are an indicator of where the action is with real money, with big money, right? You don't put big money in the bank. It's only insured up to $250,000. You try to get some yield. You put it in fixed income. No one that I know who's truly wealthy puts their money, $250,000 a piece, in like 1,000 bank accounts. You buy fixed income. You try to lock it in, lock in the gains, right? Make some money. So fixed income, corporate fixed income, How did we do yesterday? Okay, so the first thing to look at is, wow, 6-3 advance to decline. So for every one that declined, 2 went up. That's good. That means yields came down. Value went up. The promise to pay is more valuable now for corporates. However, there were still 1,116 new lows and 40 new highs. Gotta get my daughter up for camp. So 1,100 new lows for bonds, 40 new highs, 67 more unchanged. That's fine. So that's still a big number. What is that, 35-1? That's a lot, right? And so investment grade took the worst drubbing here. Investment grade at 16 new highs, 568 new lows. The promise to pay is worth less. High yield, 22 new highs, 510 new lows. Convertibles, equities are hot right now. 1 new high, 38 new lows. So let's look at agency debt. This one a little better. Look at advancers, decliners. Almost 5-1, like 4.5-1 advancers over decliners, but yet still 5-1 on the decliners on the new lows. So this is a market that's trading close to its 52-week lows. Even though, when you look at the index, well, first up, did I shut that? I don't want to do that. All right, fine. We'll look at Nasdaq. I'm sorry, what happened was I shut the Russell. I wanted to look at the Russell because the Russell is like in the toilet right now. The Russell 2000 is the worst performing index. So you might miss a little bit. I don't want you to miss any of it. I don't want to miss a thing here. Let's go. So this is the Nasdaq. We're going to look over a year, daily candle. It's on a glide path lower. In fact, if you draw a picture from the lows, this is like the worst trend line ever. But you see that trend line now, it's falling. It's falling. The Nasdaq is falling. Anyone who thinks, I'm going to make money in the markets right now, look at that trend line for the Nasdaq. I mean, it pops up, and then it comes back to the trend line. I'm just reading something about trend lines. That's why I did that. So let's look at it for the E-mini futures, for the S&P 500. Just a simple trend line. From the last dip, where we are now. Look at that line. It's so pretty. You see a nice, easy decline on the S&P. I would say, it'll hiccup a little, but you're in a decline. That's it. It's slightly falling. Actually, it's not even that slight. That's a pretty good fall. From 4,500 to 4,000. So it's the trend line, not the index, right? So the trend line, January 1st was at 4,500. By mid-April, it was at 4,000. And it looks like if we follow the trend, if the trend is truly our friend, we will be at 3,500 in July, mid-July. I'm betting on that. I'm betting. Although we are still long our two favorite stocks, Corbis and American Shared Hospital Services, which continue to be the ultimate in heartbreak. Right? There's no Roy Orbison song that's going to capture the heartbreak we feel by having Corbis and American Shared Hospital Services. See, I think we're going to wrap up the video now. I think I just depressed everybody. But let's see what else we have. There was something else really super important, actually. Super duper important. This is the thing that kind of freaked me out yesterday. A lot. I was very unhappy about this. I didn't understand it, and I thought something's broken in the market. So, a few days ago, I think it was Friday or Tuesday. Tuesday's 2 days ago, and I'm rubbing my head. I can't take it anymore, right? Let's look at the 5-day chart, because it might have actually been Tuesday. Yeah, it was. So Friday and Tuesday, short-term money was 1.135%. So 30-day treasuries, over 1%, 1.13, 1.1, 1.2 almost. Back down to 0.9. Why is short-term money so cheap? Why doesn't anyone want money? Why are they willing to give it to the government and buy 30-day paper for less than 1% when the consumer price index is 8.3%? And just think about this. Consumer price index, this is the Bureau of Labor Statistics. It's bls.gov CPI/CPI. All items, 8.6% inflation. Without food and energy, 6% inflation. So it's really 8.6, but maybe you argue it's 7. You feel good about things, right? So inflation's at 8.6%. Why is anybody giving the government money for 0.9? I know why. Because it's a risk-free place to park. It's like a free parking spot in the city of Chicago. You don't want to pay the $3 for the meter, so you take it, right? The U.S. 10-year Treasury note this thing was yielding almost this was 3.24% up to 3.3%. This was a solid yield, right? 3.3. I felt like, oh, we're finally gonna have good interest rates and stuff, but it came back down to 3.1. And in fact, yesterday it was at 3.15 for most of the day, right? Down 5%. I was wondering why that was. And the 30-year, same thing, 3.23%. So people are willing to lock up their money in a time of 8% inflation for 3.2%. And so the only thing I can think of is that there's a recession coming. Because you just want to park your money. You're not building a factory. You're not buying houses. You're not going to build a road or a bridge or a new airport. You're not going to build a skyscraper. You're not going to invest in new pigs. You're not going to build a new blast furnace. None of those things. So you're not borrowing long money. So I look at this and I think this is really about Fed tightening here, but now it's about recessionary fears here. So in a recession, we invert the yield curve. In a recession, generally speaking, the yield curve inverts. What does that mean, Jeffrey? What the hell's an inverted yield curve? And why are you telling us? Because it's a sign of possible inflation. So an inverted yield curve would mean that 1 month, 3 month, and 6 month money is actually more, it yields higher, it's worth less than long bonds. Long bonds are worth more because there's nowhere to put your money. You're not going to put it in the bank. You're going to salt it away in risk-free 10 and 30-year money. Now, I think we're far away from that, but I want you to look for a minute. 2-year money is yielding 3.06. Call it 3.1. And 5-year, 10-year is yielding 3.2. It's actually 3.06 to 3.16 is 10 basis points to go from 2 years to 10. And to go from 1 month to 30 years, the spread is 2.27%. So you're taking 2.27% more yield to give the government your money and not get it back for 30 years versus 30 days. Now this curve is a nice gentle slope up and then it flattens. But what happens is in a true recession, we're not talking about a monetary recession, but a real like gut-wrenching, lose your job, shut the factories, stores go under. The short-term yields will go up and the long-term yields come down and the yield curve inverts, and it means people don't know where to put their money. They're worried about maybe future inflation, and they just want to salt the money away. So I saw that yesterday, and I didn't like it, right? I don't like it when the 30-year Treasury bond gets stronger, goes down. I don't like it, right? Because I think there's certain things going on that should be correcting. So if we look at FinViz and we take a look at how the bonds are trading, you'll see that 30-year bonds are at 136. So we had talked about these numbers before, right? 137 was a support level for the 30-year bonds, and we're coming back, maybe 140, 135 to 140. We're coming back to that support level. The 10-year at 117, we're coming back to where we first started tracking it. The 5-year at 111, you can see the slope up. And the 2-year, slope up, slope up, slope up, slope up. So what's happened is the yields bottomed. The yields went up the most, and the value of the bonds went down. And it looks like it really made its move kind of that beginning to middle of June. And so that's when mortgage rates flew higher over 6%, which then puts pressure on housing. And so it's a pretty dramatic drop in the value of your long-term fixed income, which is why if we go back, you'll see that actually fixed income had a lot of new lows. And that was the point, right? A lot of new lows on corporate debt, on agency debt, and we saw it before, right? A lot of new lows on stocks, and right there, 11 new highs yesterday, 596 new lows. Most of the indices we track that move with the market, in the same place. Let's take a look at the COVID, see how we're doing with the COVID. We're going to set it with hospitalization. New hospital admissions, 7 days. New hospital admissions are climbing, 4,400. New COVID cases are falling, 93,000. Now, we had read that there's a new variant, a new COVID variant. And I think it's important. I'll never get it right? But it's the new COVID variants. And it's BA4 and BA5. And what we heard is this is less likely to be deterred by previous COVID infection or vaccination and boosters versus the original COVID. And the numbers we saw is it was like 16 times less susceptible to the antibodies. Susceptible has one S. So what that means is people are going to catch COVID again. COVID has evolved. In the United States, I want to say something like 35% of all new COVID cases are BA4 and BA5. So COVID's not over. The good news is it's only putting 5% of the people in the hospital. But COVID's not over. Don't think it is for a minute. Any other data? No. We'll take a last look at the futures, or I guess we'll take a first look at the futures. So futures are green. Wow, Jeff. What are y'all gloom and doom for, right? Stocks are going up today. Didn't you see the futures? They're up 0.5% for the Dow, 0.7 for the S&P, 0.9 for Nasdaq, and 0.5 for Russell. That's worth a look. How's the Russell doing? If you look at the Russell through November, it's flat. Looks great through November. If we look at it from November now, it's just pain. 2,400 down to 1,700, and it recovered to 1,700. It's just a decline. So you're in a downtrend for the Russell. I remember at around 1,800, 1,900, I was having a debate with a guy. He's like a famous guy, too. I love it. And he said, Jeff, you should tell people to buy the Russell. It's great. You should buy the IWM. Where is it? At 178. He goes at 180. He's like, Jeff, come on, man. What are you putting such a fine edge on things? Just, it's retail. This was a real guy, like a real player in the business. And I said, I don't think so. If these are my clients, I don't want them losing their shirt. So you look at IWM at 169 pre-market, and that's up, right? So figure you take off a zero, right? So 1,700 would be 170. He's like, tell him to put the money. I'm like, no, don't put your money in. And the reason I say that is it's in a decline. And so even if it flattens for a while, it doesn't mean it stopped falling. There has to be a reason to stop falling. So it hit 17, 18, went up to 19. That is what you call a intermediate reversal. And then it just collapsed from 19 to 1660 something, 1663. And I'm sure plenty of people that didn't know any better bought high. They bought it. They didn't want to miss out. Fear of missing out. So they bought it in early June. Maybe it's the kids home from college. They lost a ton of money, 10, 15%. Now they're licking their wounds. Oh, all hurt, right? So here's the thing. It's not going up. It's going down. Look at that trend line from November. It's going down. And now with talks of recession, and COVID's not over, and interest rates are acting weird, and inflation is at 8.3%, I don't know what to do. Let's take a look at the commodities. So the other message in the market is always commodities, right? So where are we in commodities? Do I have 52-week high and lows on this one? I don't. Let's take a look. I got volume. It doesn't really matter, right? So what I really... Just focus on the first couple of columns. Zoom it up a little bit. We're looking at commodities. Copper, 387. This thing was 450. Crude oil, 105. Natural gas at 670. Gasoline at 382. Lumber, 590. So when I look at this, I think many of the commodities that we use to make things are down. But there's some other. CME, hot rolled coil steel, 880. Oh, that's lower. No, hot rolled coil steel's lower. Fuck. That means your steel companies are going to get even less. How about if I'm buying scrap? All right, at least scrap's a little cheaper. 520 down from 525. The problem is that I just read that logistics costs are now 8% of our economy. They're up like 22% over the year. So if you're in the steel business and the scrap metal business, it's labor, it's gasoline, it's trucks. It's a lot of process to get that stuff in. So this isn't helpful. What other good commodity? If you have any, throw them out on Twitter. We'll go back to FinViz. They got some pretty graphics on commodities. I guess silver at $21. So silver's down a lot. I look at that and I think silver has some industrial uses. Platinum is down. Platinum has a few industrial uses. Your foods are down. Not that people are less hungry. Trust me, I'm hungry. I had breakfast, I'm still hungry, right? But things are down. So what I would say is, well, orange juice is up and cocoa's up. Luxury goods. The VIX is dropping. And look at that, the 30-year bond at 136.38. We're getting back to where I started tracking it. It's not bad. Okay. So where's the market today? It says it's going to go up. But what I would say is that the trend is your friend. Go to Yahoo Finance. Go to Yahoo Finance. Click on S&P 500. This is the S&P futures, the E-mini futures. Do a full screen. You can look at it over a year. You can look at it over 2 years. It doesn't really matter. You draw a line. So you go with the little pen line. Sometimes I like to make it a little thicker. I'll make this one a dotted line on the way up. So on the way up was pretty consistent. You could see it followed a line. It was almost like God drew a ruler, right? On the way down, it's not quite the same because the candles or the daily difference between the open and the close, the high and the low is the line. So you see those lines going below right there? I think they call those hammers. That means that at some point during the day, the market touched a very low amount, but it didn't close there. So, straight up, small candles, less risk and volatility. You had one hiccup there right around September of last year. That must have been I don't know when that was. And now, the market's going down, but it's going down with very large candles. It's a lot of volatility and a lot of variance each day. But it's still a very clear decline, and it popped up late March, early April. But yet it's staying strangely consistent around that decline. We're in a downtrend. You could have a bear market, what they call bear market rally, but they're not even that long. 3 days, 1 day. These are weeks, I'm sorry. 3 weeks, 1 week, 1 week. These are 2 weeks. These are short rallies on the way down. And so, just be super careful out there. I'm basically calling that we're in a downturn and that you should not be long this market. You should not make those crazy bets. Just don't do it. If you need to be long, also be short. So do something to offset that risk of yours. So thank you very much for listening. I hope you liked it. Market's open in about an hour, so you got time now to act. I believe all this market rising in the morning and then fall, like look at that. Market rose in the morning, up, down, flat. Up, down, flat. Right? This is the trend, right? The trend is I'm going to sucker people in with early morning pre-market bets. If I'm Mr. Market or Mrs. Market, I'm going to take it higher. I'm going to get a lot of people to sell me their stock. Actually, they're going to buy my stock. I'm going to sell it. I'm going to sell my stock. And then all day we're going to loosely dance back and forth. And at the same time, do not forget, it's gone, but don't forget the game theory, which is people want you to hold while they sell. That's the best outcome. But what really happens is in the end of the day, everybody sells, which is why the market goes down in a recession. And so good luck out there. Be safe. Manage within your risk. Oh, if you like the video, hit the subscribe button, please, on YouTube. It's free. It really helps us. It tells YouTube you liked it and that you want to know more So that helps us. How it helps you is you get notified. Like today, we just set up this video like 5 minutes before we went live. You would have gotten a quick email or a quick notification. You'd be like, oh yeah, Jeff's online. Let's see what the guy's got to say today. And then drop a comment below. We like that. It really helps. We had a comment yesterday. It made me almost cry. It was the nicest thing I ever read. It was on the 21st video, and it said, you really help investors and students in my class to learn about the stock market in the way you speak about it. Thank you. Keep up the good work. I felt so good. It was nice. But you can also come out there and say, Jeff, you are full of horse dung. How could you think that hot rolled steel is only trading at 905? You're a big knucklehead, right? By the way, it was 880. It just went up. That's nice. Hot rolled coil steel is cheap right now, right? It's great. Jeff, this is the time to buy steel because the ones that make it are the ones that survive. Another consolidation. I don't care. Leave a comment. It really helps. Let's have a discussion. And if you'd rather follow us on Twitter at Chicago_Quantum, and if you want to take a look at our website, it's www.chicagoquantum.com. We are investment advisors. We do charge money for our services. We would like you to buy our services. It would be great, but you don't have to. All the videos and stuff are free. Got a newsletter service, got stock analyses up and down. It's great, right? Research. We publish all of our insights. There's so much data out there. I've had people say, Jeff, why do you put all the data out there? All this content about stocks that have gone up and down, and leptokurtic, platykurtic, skewed, beta, dividends. Because we want to share the info, because we love our model and we actually believe in it. And so, all right, you take care now. Good luck in the markets. So that the Spider's at 376. I remember when it was fighting at 400. The Russell, 168.5. I remember that was 200. And the QQQ, when it broke 300, was a big deal. And so you're dropping through support. All right, take care. Bye-bye now.